Hi, and welcome to the third quarter SEM market update. This is a feature that we used to have several years ago. We stopped doing it for a while because honestly, things were quite boring. Nobody wanted to hear, hey, things are looking good, same old, same old. So we stopped doing it. We've had some of our longer advisors over the last few months request that we bring this feature back. So it's something that we hope to start doing at the beginning of each quarter, where we take a look at SEM's economic models, where we're at as far as market positioning overall, and then how SEM models are adapting to the current environment. Before we get too far into this, we do need to understand that everything that I talk about today is for informational purposes only. I don't believe I'm going to talk about specific performance of our models. If I do, just know that past performance is not indicative of future results. Everything involves risk, including those things that are managed by SEM. Now, the first thing I want to look at is just overall, where are we at with the economy? And one of the things that you will see is if you look at actual GDP growth, zooming out to the last 60 years or so, we've had a nice steady uptrend there on the right-hand side of that chart. And one thing I do point out to anybody that will listen is this started before the election. It started in mid-2016, and it's been a nice steady rise upward since then. The dark, thick orange line there that you see on the chart, though, is something that I think bigger picture-wise we all need to keep in mind, is that despite unprecedented growth, both from the Federal Reserve, unprecedented stimulus from the Federal Reserve, the Obama administration, and now the Trump administration, we've not seen economic growth on a year-over-year basis exceed the long-term growth rate. That's something that we're not going to be able to solve on this webinar today. It's something that is not going to be solved with a bunch of rhetoric during the election season. There's deep down structural issues that our economy needs to address. All of those things I believe can be addressed, and I think the dialogue is shifting that way. Unfortunately, the solutions are going to be painful for the market. So it's something we need to keep in the back of our mind when we're looking at the next 5 to 10 years as far as stock and bond investments go. Now, one of the things I put in there, just because it's a big pet peeve of mine, and you see a lot of noise coming out there with the GDP numbers, is I think the economists are the only people in the financial industry that are allowed to take the last 3 months and essentially multiply them times 4 to get a number as far as what the annualized growth rate is. It is not how we would do investing. We don't take how did we do last quarter and multiply it by 4 to give you an idea of what the one-year returns are. So what we do at SEM is we use the blue line in all of our projections. That's the year-over-year percentage change. It takes away seasonal factors. It takes away any of the adjustments that you see happening on the quarter versus quarter numbers that the official numbers do. And you can see that there's a lot of noise. Sometimes we see, oh, look, 4% growth, and other times we see 2% growth. I think we're going to see sub 2% growth, maybe even below 1% growth in the quarters ahead on the official number, but the one-year number is not that bad, and so please keep that in mind when those numbers come. Now, let's take a look at just the economic scorecard here. These are some of the inputs into SEM's economic model. They're also in the Conference Board's leading economic indicator numbers that they use. And I think the main thing to look at there is there's not a lot of green arrows. The 36-month trend that I have in there, those lines, that's the year-over-year percentage change. So even something that's been positive, like the number of jobs being created, the overall trend in growth is down, and it's something that we have to be aware of. There's not a lot going for the economy. I will say, if you've read my blog recently, cutting interest rates is not going to spark a lot of changes in these numbers. So it's something that may help the stock market, but probably will not help the economy. Now, as far as our economic model goes, this here, the solid blue line is the 12-month prediction of our model, and you can see it is falling very quickly. And the numbers, I wouldn't say are breathtaking, but it has been a big fall off and a lot of it's the consequences of the trade war. We're also still feeling the impact. Keep in mind it takes 9 to 12 months for one change in interest rates to filter through to the economy. So we're still feeling the pain of last fall's and last December's interest rate hikes from the Fed. So even if they were to cut rates today, we would not feel the benefit of that in our economy for 9 to 12 months out. So it's falling quickly, and nothing the Fed does right now is going to change that momentum. So please keep that in mind when you start to hear how great it is that the Federal Reserve cut interest rates. It's a very delayed response as far as the economy goes. And quite frankly, it may be too late to save us from a recession, but time will tell. Now, as far as the stock market goes, I like to show this chart just because it seems to be what investors focus on, which is the last 10 years. Buying the dip has been a very good strategy. Every time the market's gone down 10 to 18%, if you jump in and buy, it's gone back up and you've been rewarded for it. What people forget is there's been lots of times in the history of the market. Here I look at the stock market going back to 1990, and there's a few key numbers up there. First of all, the number at the top, 8.2% annualized return going back to 1990. That's a pretty decent number. But what we've seen is during that time we had an almost 16% return during the tech bubble, almost 15% return during the housing bubble, and now a 14.3% annualized return during what I'm calling the liquidity bubble, and we'll talk about more on that in just a couple minutes. But it is something that we have to be well aware of, is every time we've seen really big periods of growth, that's been corrected by an 18 to 24 month bear market where we lose 35 to 50% of the value in the stock market. So where we're at in the market, it's been great. Buying the dip has worked. However, this is not normal. 14.3% is not normal. We should expect 8% very long term, but anytime you've gotten way above that, you typically go into lower returns for the market. And in fact, one of the things that we keep reminding people about is valuation matters. Where we're at in terms of whether it's price to sales, price to earnings, some of the book value to price, things like that. Regardless of whether you look at the chart on the left that shows the average of 4 valuation indicators, or my favorite valuation indicator, the Buffett indicator, which is the value of the stock market divided by the underlying economy, we're at levels we've only experienced during bubbles, and it's the highest valuation we've seen since the tech bubble. So it's important to understand that it's extremely highly valued right now, and if you're buying right now on a 10-year basis, you're buying with the assumption that valuations can go even higher, and I don't think that's going to happen. I do have a key note there at the bottom of the page, which is valuation is not a timing mechanism, but it can help you predict what types of returns you should expect for the next 10 years. Looking at the numbers, the Buffett indicator not only makes economic sense, because if you think about it, the way GDP is calculated, and the way you're supposed to look at investing in the stock market is you're buying the future streams of earnings when you buy a stock. And all of the US based corporations, whatever sales they have, end up filtering down into GDP. So you cannot have for a prolonged period of time the stock market being worth more than the economy. It'll get ahead of itself. You have a recession, things correct, and then you have a better opportunity to jump in and buy stocks. And if you look at it, the best opportunities have come when the stock market value was well below that of GDP. I put a green star there of 2009. Would have been a great buying opportunity. That's how you get those almost 15% annualized returns. But then if you look at where we're at now, we're at a period where returns have been negative for the next 10 years. And that doesn't mean right now, based on the Buffett indicator, we're going to have negative 4% every year for the next 10 years. Typically what you see happen is you have that 18 to 24 month bear market, and then you spend the next 8 to 9 years recovering those losses just to get to a minus 4% annualized return over those 10 years. So again, it's not a timing indicator. It's nothing that we use at SEM to determine our asset allocation. But if you're trying to set expectations for the next 10 years, buying and holding is likely going to be a very difficult endeavor. And we've seen even during the best of times, most investors don't stick to a buy and hold strategy anyway. So if you're looking at these types of difficult returns, I don't think buy and hold is the way to go for most investors right now. Let's jump to the bond market, because people look at bonds and they think it's a very safe investment, and most of the time it's a nice diversifier for a portfolio. But if you've gone to my blog, and I have a very long research paper called Investment Grade Junk, one of the biggest concerns I have is the broad range of what's considered an investment grade bond gives you a big disparity as far as the strength of the companies that are inside of that. And one of the things that has happened because of the Federal Reserve's policies and the free money that's been floating around is the half of the investment grade bond market is literally just one step above a junk rating. And the reason that has consequences is most banks, pension funds, insurance companies, they're not allowed to own a very high percentage of non-investment grade bonds in their portfolios. And so we're just a matter of another recession away from seeing half of the investment grade bond market being suspect to being downgraded to a junk bond. And if you can't own a junk bond in your portfolio and you have to start selling, that causes stress in other what is considered right now investment grade, but that triple B space area of the bond market. And looking ahead, one thing that's a huge concern for me is we're stuck with the ratings agencies, and everybody, despite the experience that we've had in leading up to the financial crisis, they still seem to trust the ratings agencies. These net leverage ratios of how much debt versus capital that these companies have is alarming. If you look at it, the leverage ratio back in 2007 of triple B bonds was 2-to-1. Now, fast forward 10.5 years later, and we're talking a 3-to-1 leverage ratio for what's considered an investment grade bond. That's just it's alarming to me. That's junk status back in 2007, yet they're considering it investment grade status right now. And so the higher leverage always leads to higher default rates during a recession. And again, I don't know how we avoid a recession. I don't know that anything's ever happened. Despite 100 years of trying, the Federal Reserve has never successfully avoided a recession. And it's inevitable that we hit that. And when we do get the recession, the most highly levered companies are going to have a hard time paying back their debts. Here's a couple more charts from the investment grade junk research paper that I wrote. The first one I think is interesting is if you look at the leverage ratios, it's hard to argue that triple B bonds are not considered high risk. They have 33% more leverage than they did last time we went through a recession. So if you consider triple B bonds high risk, that's 2/3 of the bond market is at risk right now. That's unheard of. So of the 2.5 trillion, 67% or $5 trillion is in high risk debt. Worse, if you look at, I've added up the numbers there on that bottom chart, 75% of the corporate bond market is rolling over in the next 5 years. In other words, that debt's coming due. And unfortunately, the data has shown very few companies use the debt to actually invest in things that will grow their earnings and make them more profitable. Instead, they've used debt to buy back shares and to issue dividends at unprecedented levels. And so now they have nothing to show for that except a higher stock price. So now as this debt comes due, they're going to have to refinance that at whatever today's market is showing. And again, if you start to run into defaults, the interest rates on corporate debt is going to spike significantly, just as it's done throughout history whenever we get into a recessionary environment. And it's going to be a very difficult time for the corporate bond market. Now, finally, I threw this in there because investing is all about risk reward. And one of the nice things that the Federal Reserve has given us over the last 2 years as they've been raising interest rates is you can basically get low risk savings rates, money markets, whatever it is, at the 3-month Treasury rate, fully liquid 2.2% right now. Versus a 10-year Treasury bond, you could loan money to the U.S. government and get 2.1% over the 10 years. But even stepping out, look at the difference between AAA corporate at 3.4 and then what's considered one step above junk on Moody's scale of BAA, which is the same as triple B. Only 1% difference to take on all that extra risk that you would have going from AAA down to triple B. And you can jump then to junk bonds of 6.1%. So you're not really being compensated much at all for all the risk that you're taking in the junk bond space. Now, what does that mean for SEM's models? Quite simply, I think this is a very interesting time and a great time to be an advisor or be a client of SEM, simply because our diversified approach. Now, for those of you, just to recap that aren't familiar, we have 3 different investment styles that are completely unrelated to each other. Tactical, short-term in nature, tries to look at the trends, wants to capture as much of the upside as possible while avoiding as much of the downside as possible. Then we have our dynamics based on our economic models, and then we have our own version of strategic asset allocation on Ameriguard. And we'll talk about each of those 3 here in a minute. But what's fascinating is the tactical, especially the bonds, are mostly bullish going into the third quarter. Our dynamic models are bearish, as they've remained since the February of 2019. And then our Ameriguard is sort of neutral. It's actually leaning bullish, but the underlying investments have taken some stock exposure off the table, particularly a big chunk of Ameriguard is in real estate, as well as some asset allocation funds. So even on the growth side, we have some bonds mixed in there to give Ameriguard a different flavor. Looking at our tactical models, this is my favorite chart. One, because it shows every buy and sell signal, in this case going back to 2007, that happened in real time. But also it shows that there's going to be times where it appears that we're not adding value. We're buying sometimes at a higher level than we sold. Sometimes we're selling at a lower level than we bought. But if you focused in there at 2007 to 2009, you could see a lot of buy, sell, buy, sell, buy, sell. And each time we sold, it was because the signs showed that the risk was evolving into the market. When we got that sell signal in June of 08, we had no idea what was ahead other than things looked risky. And when in our models, that means a 6 to 10% or more loss potential for the markets. And I do apologize, they are mowing outside of our office today. So if you can hear some of that background noise, it is a bit distracting. I do apologize for that. But we also can see that the goal is to chop off the worst downside. And we've had, even in 2011 and in 2015, 2016, 10% drops in the high yield bond market. And what SEM's done is be able to take away, by the time we got back in, over half of those losses. And I would not expect it to be any different, because this is our most conservative investment model. It's inside a tactical bond. It's inside of income allocator. Our platinum portfolios use similar type of metrics, and its job is to, when it sees signs of trouble, get to the sidelines. That includes being able to go from junk bonds, which are giving us a nice 6% yield right now, and moving into short duration or lower risk bonds, and just writing it out until there's a better opportunity. Looking at our dynamic portfolios, I think this is probably to me the most interesting and most exciting style that we've had over the last 6 months. The red line there shows the changes in our signals based on the economic trend, and you can see a short November through February period where we were neutral on the right hand side, and then we got bearish. And what that means is we've gone in the matter of about 6 months from having high exposure. Our dynamic aggressive was overweight small caps into the fall of last year. Our dynamic income was very heavily invested in dividend growth stocks. But now that we're in this bearish mode, we have no small cap exposure. Those are the riskiest things when you go into a recession. We have no dividend growth exposure on our dynamic income model. Those, again, are very nice when the market's going up, but they can lose 30 to 40% of their value during a recessionary bear market. And so we're writing it out where we have lots of treasury bond exposure, both on the dynamic aggressive and the income side. And then we have some short duration bonds. We also have some tactical fixed income where we're letting other managers decide when to get out and retreat to the sidelines. And these are all managers who have been through both of the last deflation of the asset bubble. So it's a very fun portfolio, and I think it's a common sense portfolio. It's all quantitatively based, and it should be a portion of most investors' portfolio, regardless of if they're really long term or shorter term. It's a very nice diversifier from some of the other things I see out there in the investment market. Finally, Ameriguard is our version of strategic asset allocation, and what makes Ameriguard different is it's not going to just buy and hold and keep rebalancing back to the same asset classes. We have 4 different look back periods. We have 4 different indicators to determine where should we be, and then whether it's a balanced portfolio that can go from 70% invested down to 30, or our growth, which can go from 100% invested down to 70. There's a way to use that inside the portfolio for longer term money. Again, it's leaning bullish right now. The trend is saying be all the way in, but then the asset selection is taking some of the money off the table, which is, again, a neat, interesting transitory position, as nobody can really tell you right now with much confidence which direction the market's going to go next. So it's a really nice hedge. Again, it belongs in the longer term portion of most people's portfolios. Why do we do what we do? I think it's important to close this out because I've showed you a lot of data, and honestly, the market can go either way. But what we've seen is human nature is behind all the moves in the market, and we see overreactions both on the upside and the downside. There's no perfect signal that says this is when we got the buy signal or when we get a sell signal, but what we see is most people end up letting their emotions dictate their asset allocation. The cost of this, we just got the updated Dalbar study through 2018. One of the things I think is interesting is for the 20-year period into 2017, S&P 500 had returned 7% per year, actually 7.4%, and the average stock investor had earned about 5.3. Well, now the S&P, if you started on January 1st, 1999 and held through the end of 2018, you only made 5.6% returns. If you go back to 1999, the average 20-year return for that period was 13.5%. So think of the expectations people had going into 1999 of 13.5% annualized returns. They only got 5.6. If they were the average investor based on when they bought and when they sold, they only made 3.9%. But the most alarming gap there is the fixed income investor is just, they get clobbered. And the reason being is they tend to be conservative, which means they tend to be a little bit more emotional. And by the way, there is zero, issues I have with somebody being emotional. I tend to be a conservative investor. I can be emotional, but you know what? I let the data make the decisions, not my opinions, not my feelings. And what's happened with bond investors is they're the last ones typically to jump into the market, and then they follow that just in time to get hammered in the stock market, and then they jump back into bonds. Well, they don't get into bonds until after they've had their big rally and then tend to kind of be flat. So a 0.22% annualized return for 20 years for bond investors is obviously not good. I took a look at our most boring, our most conservative strategy, Income Allocator. It's been run in real time since 1992, and it's made 5.6%, about the same as the S&P 500 over that 20-year period. So it's not boring. I'm sorry, it's very boring. It's not sexy at all. It's going to have periods of low returns, but looking at the last 20 years, it's beat the S&P 500. Obviously, for a conservative investor who, on average, barely made any money, it's a much better alternative than buying and holding bonds, because we find that most fixed income investors will not stick with a buy and hold bond portfolio, just like a stock investor that tends to not stick with a buy and hold stock portfolio. One of the things that I think is important is to understand our personalities. I touched on it. The most important thing that we can look at there on the left-hand side is that conservative client goes from being loss averse, where they don't want to lose any money, to regret aversion, where all of a sudden they have that fear of missing out. They jump in at the wrong time. They've watched the market go up for a long period of time. So we actually develop our portfolios based on the underlying client's personality, which is something that I think is critical going forward over the next 10 years. One of the things that we like to point out is Vanguard themselves, the company that preaches buy and hold and low fees, looked at their own investors on their platform, and they found, after paying fees, those with advisory relationships tended to have 2.3 to 4.1% higher returns, again, after paying fees, than those who didn't have an advisor. They broke it down of what where those advisors added value, and the biggest areas were behavioral coaching, spending strategy, and then asset location. Well, the approach we take at SEM is completely flipping the relationship around to what we call a behavioral portfolio approach, where step one, we work with the advisors as they create a financial plan with specific goals. Then they do a cash flow strategy, and then SEM comes in to help figure out which investment model mixture makes the most sense on those things, as well as around the client's personality. And the way we do that is we have 10 different investment models. There you see color-coded based on the investment management style, from our tactical models, which are managed daily, the dynamic models, which is the economic based. We get that data monthly, and then our Ameriguard, where we do a quarterly reallocation of those assets based on all those indicators that I discussed earlier. So it's a very unique approach. We can scale down the risk with tactical bond. We have long-term money out in Ameriguard, and we can truly create a customized portfolio for our clients. And it's something that, again, where we're at in the economy is anybody's guess. I'm going to put it out there that I don't believe the Fed's going to do anything as far as being able to save the economy from a recession. As they say, that ship sailed, and it's really difficult to turn things around this late in the game. So maybe I'm wrong, and what's nice about that is our Ameriguard portfolios are participating. Even our dynamic portfolios, being bearish, have had some nice gains so far in 2019. So check things out. If you're interested in learning more, our website, semwealth.com, has a contact button. Hit that up. Send me a message. We'll be happy to just have a conversation to figure out where things might go next. So until next quarter, or if we have to do an interim update, my name's Jeff Hybiak. I'm the Chief Investment Officer at SEM Wealth here, and I appreciate all your time.